Good afternoon, everyone. My name is David Scherer. I'm co-CEO, co-founder, Origin Investments. I'm really excited to have our second conversation today with Jay Parsons. He is prolific. I literally listen and watch most of your stuff. I'm not going to say all of it, but I spend a lot of time reading your LinkedIn posts, and they're very thoughtful. I'm going to give him a full introduction in a moment, and we're going to then cover 10 relevant issues that we see in multifamily today. I think it'll be of great interest. Just a couple of housekeeping things. We're going to try to get through our dialogue in about 35 minutes. Please use the Q&A to send in your live question. I'm going to try to actually answer all questions, but we're going to keep it to an hour. So I think that's it for housekeeping. With that, I'm going to introduce Jay formally, and then we're going to jump right in. Jay is a rental housing economist, advisor, writer, and he's been doing this a long time. So he's done it for the advising for institutions. He's done it for individual investors, pensions. He's also prolific in being an economist in his writing and observations and processing data about the multifamily housing market, which I absolutely love that you focus only on multi-Jay. It's just like us at Origin. He's been cited in the Wall Street Journal, Bloomberg, CNBC. I could go on and on. And I mentioned his social media presence. He has over 500,000 views a week. I'm part of that. So Jay, I could go on and on, but we're gonna jump right in because I know I only have you for a limited amount of time. Welcome back. The last time you were on was, I believe, May of 2023, and we were having I would say, spirited conversation about what we're going to happen to rents in the next sort of 6 to 12 months, and we're a year later. And I can just tell you, and we'll go through sort of one by one, but my own opinion has changed from where it was a year ago, and we'll kind of unpack why. And I obviously want to hear your opinions, and so does our audience. So the first thing we want to talk about today is the cost to rent versus the cost to own, because I think we agree it's fundamental to our demand function in rental housing. So why don't you lead us off, Jay?
Well, sure. And thank you for the kind introduction. Thanks for having me back. I appreciate everybody carving out some of their time today to participate in this event. Yeah, I think everyone's seen the headlines, right? I mean, the discount to rent versus own has not been wider than it's been in decades. And that's, I'll tell you, like, traditionally, my view has been, hey, people don't make decisions based on calculators. Like, I've never met somebody who sits down at the kitchen table and says, hey, do I rent or do I buy based on what some calculator says. But, clearly there's also a point where, rates get so high and, home prices have been sticky, inventory is fairly limited in most markets, that it does have an impact. What we've seen is that, the publicly traded REITs for both multifamily and single family, they've pretty much, I think, all reported that their move outs to home purchase are at all-time lows. Some of them are less than 10% versus traditionally around 15%. Some of those may end up in single family rentals, but I do think some of today's demand is explained by by current renters choosing to stay longer while they wait out the home market. And so, on a net absorption basis, that certainly plays a role. So, one of the consequences of these higher rates has been more challenges buying homes. And the Chairman Powell addressed this last week, and he's well aware of the political pressure on the Fed, which is supposed to be immune to these things, to address rates for home buyers. But it's unclear if even a modest rate cut would really get us there. So I think this is going to be a driver for at least a year or two here.
Yeah, we were actually at our investment committee this morning, and we're going to be breaking ground on a build for rent community in St. Augustine, Florida, which is it's a subset of the larger market in Jacksonville. And so one of the things we're looking at, in addition to Multilytics, which is our AI, is and our own feel about rents is we're triangulating between home purchase versus build for rent rents. which is really important. And so, first of all, most people don't have 20% to put down on a home. Certainly not in the sort of, $350,000 to $600,000, what I would characterize as starter home market that competes with rental. In fact, over 80% of homes have less than a 20% down payment in that subset. And so when you look at that, first of all, there's a barrier to home ownership, but you don't have that down payment. And then the PMI kicks in if you don't, right? Which adds, the net is in this particular market, it's $800 more a month to own a like-sized and quality home. It's just much more expensive. The other thing, and I know that you just wrote about this, Jay, and I thought it was really interesting. There's also a lot of home communities now, or rental communities, in this case, build for rent, that are providing more value than you could get in a lifetime home. It's not just about, it's about value, not just cost. So maybe you could talk about that for a moment.
Oh, absolutely. I think it's an important topic. And to your point, I like to use the data from John Burns that tracks an estimated monthly payments for entry-level homes as a more kind of a true comparison point to renters who could be first-time buyers. Because, kind of to your point, you can't just assume everybody puts down 20% like some of the home buying websites do. And so you look at it that way, there's in a lot of these markets, there's 30, 40, 50% discount to rent versus buy. And to your point, I think this is particularly beneficial to the build to rent market. And kind of answer your question, for those unfamiliar, the build to rent space is particularly unique because you often have detached walls, or maybe it's a townhome style structure where it's more of a traditional, for sale home, but it's a for rent. You get a little bit of a yard, but you also in many cases benefit from community amenities as well. And so you have some community maintenance. You have the benefit of somebody who's going to do repairs and maintenance issues at your house. You don't have to worry about that yourselves. We've seen some from surveys that one of the major advantages renters see in renting versus buying is the ongoing maintenance. So you have that headache taken care of. So I do think there's a niche that really is going to embrace this, and that's why I'm particularly bullish on build to rent for the long term. I mean, this is still, I think, in its infancy, and most markets still have relatively little of this build to rent product out there.
So we're going to shift to point two. I just want to keep us on schedule here. So inflation. You and I talked a little bit last week about this, but can you unpack how much housing is in the inflation index as it's measured, and then what's your opinion on both inflation today, because there's a lag effect to rents, and then inflation going forward?
Yeah, no. So, it's interesting, with the CPI topic, I'll tell you, it's this, I've been in real estate research since 2009. And for the first, really 11, 12 years, that time frame, I'd be in all these research communities with fellow, data nerds, and going to industry events with, lenders and buyers and all types of different profiles. Nobody ever talked about the CPI's version of rent. Like, it just wasn't a topic because, that metric was designed to be stable. So a quick history lesson is that coming out of the last period of high inflation in the 1970s, in the early 1980s, the government economists came together and they said, hey, we're going to take home prices and mortgages out of the consumer price index. We're going to replace it with this concept of rental equivalence, which we know of as owner's equivalent rent, or OER here as. And there's also this rent of primary residence. And these two things combined make up a third of the consumer price index. What a lot of people don't know is that even how we try to measure homeowners with the owner's equivalent rent is actually a survey of renters. It's asking about their rents. And there's other things about, what you hypothetically would charge for your home to rent to a homeowner, but that's just a weighting metric. It has nothing to do with how CPI is actually measured. And so my point in sharing this is that it's been I would say almost an irrelevant metric for a few decades. But what happened is that in 21, 22, rent spiked so much that it caused a disruption to the CPI shelter of rent. And because it's and I won't get too much in the mechanics of it here, but it's really a lagged measure. They're trying to measure contract rents, not the the signed or lease rents or the asking rents we see in headlines. And so because of that, it's still showing elevated numbers. And so the last point I'll share there is that if you take out the shelter component, which is all driven by rents, then inflation's already back to the Federal Reserve's target of 2%. And it's been there since last summer. So it's really all about this lagged version of rent that continues to prop up inflation. And the Fed's talked about this a little bit. They're aware of it. But it is a real challenge for the Fed because it's a purposely built, slow-moving metric. It's going to take a long time to bring this back, kind of tame it down toward the Fed's target range.
But then, Jay, the other thing, back to the first point, the cost to own versus the cost to rent. You had a really interesting article, I believe it was about 3 or 4 days ago, about record absorption. Maybe you should talk about that.
Yeah.
Because the point is, because people either can't or are making rational decisions about maybe I don't want to buy at these valuations, or maybe they can't, then they need rent. And we're seeing record demand. And so back to point 2, which is inflation, my opinion is, yes, it's lagging, but looking into 25, 26, 27, you're going to see rents go up quite a bit. It's just supply and demand, and we'll get to that too. So supply is very, very large right now, the supply hitting. There's very little supply coming, 26, 27, but yet there's record demand. How does inflation stay low when it's a third of the index is going to be, in my opinion, flipping and being, inflationary to the index? Also quite good for us fundamentally.
Yeah, that's a great question, and I think fundamentally, to your point, the irony is that high inflation helped trigger this massive wave in apartment construction, which in turn has been a massive driver influence in taming rent inflation, which was peaked at 15%. And then you look at, certain data providers like RealPage and Yardi are right around 0% now, and nationally, I should say. And it's not because of demand, to your point. It's all because of supply. There's more supply than demand. We're building the most we've built in 40 years. And but I think fundamentally it's important to remind people this is not a demand issue. It's a short-term supply more than demand issue. And to that point, we're seeing the weakest rents are in the highest demand markets, which is really an unprecedented thing to be occurring. And it's just because of the sheer volume of supply hitting this market. No, to fast forward though, to your point, is the irony here is that by keeping rates higher, that's forcing developers to not be able to build as many projects because they just can't, that these deals aren't penciling. And it's not just because the rates are high, but it's also because the rents are flat to falling. And so the math just doesn't work to build new projects. And so we're seeing in many markets starts are down 40 to 50%. And that's significant. And so that's going to inevitably lead to a period of, barring some black swan event where demand exceeds supply again. And I think by second half of next year and probably more clearly in 26 and 27, we're going to see this flip up again. And I don't think we'll be back to double-digit rent growth, but I think we'll be seeing, probably above average rent growth. And we'll see these higher supplied markets start to shoot back up the leaderboard again.
Yeah, and what Jay means by above average, the historical average, 100-year average is about 3% in rent growth. And so above average would be anything above that. I actually agree with him, and our machine learning models also are picking this up because, at the end of the day, everyone always asks, like, what's the most important variable in your machine learning model? And the answer is units per capita because it's capturing the demand curve and the supply curve, right? So the supply curve is starts, which will become future supply. And the demand curve is population growth, job growth, to make up household formation. But the big point on inflation is, and this is me, I haven't heard Jay say this, so this is my opinion. If he agrees, he'll state as much. But just as inflation is keeping CPI higher than it should be because it's a lagging effect, I believe it's starting very, very soon. I think it's Q1 of next year, maybe even Q4 this year. You're going to see rent growth start, and then it's going to accelerate above trend, above 3%. and more so in the growth markets, because that hasn't stopped. People still want to be in warm growth lifestyle cities with low taxes. That hasn't changed. And there's just a lot of supply there. It's being worked through. The demand's still there. I think CPI in 25, 26, 27 is going to be stickier than people want, because housing is going to invert and become this upward pressure. And unless the other 66% is negative, it could be, it's going to have a difficult time getting to 2. All right, I'm going to move on to 3, and we've started to touch on some of this stuff, which is great. But let's talk about, you mentioned it, Jay, but let's just hit unit deliveries now, in particular in these high growth markets, because that's where really the supply has been quite large in the last year.
Absolutely. And just kind of bridging the last point of this one, there's an article in the Wall Street Journal today about, kind of the looming reacceleration of rent growth. And it's already happening in these lower supplied markets like those in the Midwest. And it's, modest reacceleration. I think what they're going to see is, kind of back to that, 2 to 4% range, where they're more steady. But what's happening really, to your point, is in these higher supplied markets in the Sun Belt, we're seeing peak supply hitting this year. Some of that's going to carry over, I think, into the first half of 2025. But as these units work through lease up and less comes behind it, we're going to see a significant drop off in supply by second half of 25 into 2026 and 27. And, I tell people all the time, I probably said this last year too, is that, forecasting is an inexact science. I'm sure whenever anybody hears a prediction, you take it with a grain of salt. But you have to remind yourselves, like, supply is the easiest variable to forecast, because it's just starts push forward, 18 to 24 months, depending on the size of the deal and the location of it. And so we know with strong certainty that, there's a lot of reasons for it, higher rates, the current wave of construction, flat to falling rents, sticky construction costs. All of these things are making it harder for developers to build new projects and challenge raising capital for these new developments as well. And so that gives us certainty that that's going to be happening. And I think it's going to be very tough to see a meaningful acceleration in supply anytime over these next 2 to 3 years for that reason. So yeah, I mean, the paradigm or the story is going to shift, I think, pretty significantly.
Jay, can you educate the audience about how violent just the movement from massive amounts of starts to where we've been for the last 6 quarters? I think people probably don't have an idea of the magnitude of the change.
Sure. Yeah. So, just to give you some kind of rough numbers here is, the starts, are, as I mentioned, I mean, you look across the country, we've seen starts that are dropping, like in Texas, and most of the Texas markets, we've seen a lot of high construction are down 40 to 50% on starts. And even in permitting, you look at areas like Dallas and Houston, just pulling some examples here, where starts are getting to be below the 2010s decade average. And so that's a really significant change from where we were last year. Another thing I'd point out is we're now at a point in the cycle where completions are outpacing starts. So meaning we're completing more projects than we're starting, and that's going to continue. In fact, year to date 2024, the gap between completions to starts is the largest gap that we've seen since since 1970s or early 1980s, meaning that the sheer number of completions versus starts is starting to really, really widen, which means, fewer completions, going forward as well. So, these are very, it's very important to know, like, this isn't just a modest drop off in supply. This is a very significant drop off in supply. I'll give you another stat as well. When you look at the National Multifamily Housing Council, they report on, top developers across the country in terms of starts each year. And, across the board, when the latest numbers came out for last year, they're all seeing significant declines. We saw some of the biggest names in the country were down 20 to 50% on starts. And the only ones that saw meaningful acceleration were niche developments for things like affordable housing, student housing, attainable housing, middle income. So it's traditional kind of market rate construction is, down significantly, and I think it's going to remain that way for a while.
Yeah, and it really started in the middle of 2022. This isn't like we lost a quarter or two. We've lost almost 2 years at this point, and there's going to be an impact. So when you pair housing that's very difficult to buy, the for sale market, it's very difficult to afford, and on the rental side, there just isn't enough supply to meet the demand that's creating. It's setting up to be a pretty extraordinary time for raising rents in 26, 27, 28. Okay, so in terms of, let's shift to market conversation. We talked about just broadly, Jay, what markets, I get this question all the time, what markets do you like? Not so much looking back, but looking forward. So you see all the data. So it would be easy to say, for example, right now rents in the Midwest and some of these smaller Midwestern cities that are undersupplied are doing better. But you believe that that's where you would want to invest if you had to invest somewhere for 10 years, right? Which real estate is a longer term investment. So where would you want to be investing geographically if you had a 10-year outlook?
Yeah, no, that's a great question. I get that one too a lot, and I'll tell you, I do think there's a play in the Midwest. I see more interest in places like Indianapolis, Kansas City, Columbus. Where there's a slow and steady, kind of lower volatility story, predictable return. But and so I don't want to dismiss that, but I do think. Let me go back. I'll tell you, I wrote a paper for the Pension Real Estate Association in 2018 that was looking at really the major Sunbelt markets versus the coastal markets. And, previous cycles, these big coastal markets like New York and Los Angeles, San Francisco, really viewed as the, core markets. But, core definitionally, if you like commercial real estate 101, is supposed to be low volatility, predictable returns. And I think what's changed, not since COVID, but really since the great financial crisis, is that those markets have not been behaving like core markets. And instead, what kind of my paper was showing here is that your major Sunbelt markets have been driving, better risk-adjusted returns and lower volatility with a better return, actually. So my view is that, and that continued, by the way, up until, really late 22 and into 2023 and where we are now. And that's just because of the sheer supply volumes that have been chasing that demand. And so I'm of the view, I think it's, I'm a supply and demand guy. I think it's pretty simple. You follow the people, and supply is cyclical. And we know supply is going down. And so I think we're going to revert back into what we saw prior to not just the peak inflation period, but really that 2010s decade where we saw these larger growing Sunbelt markets that were outperforming. And so I look at Texas, Florida, Carolinas, Tennessee. Like, I think these are, and I could go on. I don't want to be exclusive to those, but just giving some examples. Like, I think these are markets that I would still be betting on for the long term.
I'm going to move us along. I agree with that. That's where all of our offices are. So we've made a really large investment in development in the cities and states that you mentioned. Let's talk about renters, and in particular how resilient they've been really throughout. I mean, just start with COVID. They paid their rent, but they've made it through these enormous increases in rent. Rent income ratios, which are now coming back in line. Maybe speak a little bit about the resiliency of the renter and how now the affordability is much more in line with market conditions than maybe it was in 21, 22.
Sure. Yeah, I think first and foremost, and I'll probably get more of this later, but I think there's a lot of misunderstandings around affordability. And so let me just for now, and there are some real challenges, don't get me wrong, but I think it's a different segment of the market. So let me focus now on, you look at traditional kind of market rate renters and professionally managed multifamily, this segment of the market has shown to be very resilient. They paid the rent through COVID. We never saw delinquency shoot up like the doomsdayers thought it would. And then, we saw peak demand even during the periods of peak rent growth, because obviously the two went together, people again paying the rent. And then now we're at a period where rents have softened, and we're seeing wage growth that's exceeded rent growth for new leases for I think 16, 17 straight months. And as a result, we're seeing rent income ratios that are coming back down. I was looking at some data recently that was showing that rent income ratios are approaching where they were before the pandemic hit. I think we're right around 22.5% right now for market rate apartment renters signing new leases. So I'm of the view that, number one, we continue to underestimate renters, and number two, that I even think affordability, I'd go so far as to say as affordability is emerging as more of a tailwind than a headwind for the rental housing space.
Yeah, in terms of the affordability ratio, we actually really, it's such a difficult thing to put your hands around because, in particular, maybe you can speak to this. How do you handle affordability when you're looking at a gentrifying neighborhood, right? Because this happens to us all the time. It doesn't have higher end housing stock yet because it's gentrifying, but we believe, and our machine learning believes, that this is the next area of growth, and it has catalysts. But you will not start on a development if you look at the affordability ratio today. So how would you approach that, Jay?
Yeah, well, that's a tough question. I think when you look at new development, obviously, I think there's a little bit, I don't want to oversimplify this, but I do think there's a little bit of a, if you build it, they will come. And we've seen this across some gentrifying neighborhoods where you take crumbling parking lots or vacant buildings, turn them into nice apartments, and that does bring in a higher income demographic. I think, there's also challenges with aging properties that are struggling with ongoing maintenance issues. And you're kind of put in a situation today where to really have the property, you have to meaningfully increase the rents. And so, I think from a public policy perspective, it'd be good to see some, and that creates tension, obviously, right? And so I think in those cases, that's where there are real challenges about resident turnover to afford the rents that are required to properly renovate these properties to modern standards, including safety standards. So that's a little bit of a nuance. And I think we do need some public policy programs, tax abatements and whatnot to help.
I think Jay froze up, but I'm going to we're going to move on to the next.
But, again,
there you are, Jay. You froze up for a second, but we're going to move on to really what the media covers. And in particular, they sort of hone in on a monolithic concept of a renter when increasingly, again, back to the very beginning, if it's the one theme I want people to really take in and at least contemplate. Are we in the middle of a secular change where home ownership isn't what it was in the 50s and 60s? You were sold this dream and many of us bought into it, but home ownership maybe isn't for everyone. And maybe the market doesn't allow that either because you don't have 20% down and it's much, much more expensive to buy than rent. But the media in general, or even just us as humans, we tend to associate rentals with one group of people. That's just not true anymore.
Yeah. Yeah, no, I agree. I mean, first of all, I think perceptions can change over time. I mean, you ask somebody today if they want to buy a home one day and they say, no, never. And, 15 years from now, maybe they're married and have kids and their opinion changes, right? So I think what's really happening here and really been going on for a while is that, I'm a big believer in this concept of, kind of this delayed adulthood trends, right? Where you're seeing people who are staying in that apartment stage of life longer. And so somebody who 20 years ago would get married at mid 20s and have kids, maybe in their early to mid 30s now. And, that difference has a tremendous impact on apartment demand. So I think that's more likely to continue for various reasons.
Yeah. And also the advent of more remote work.
Yes.
That comes with a flexibility that only is associated with renting. Home ownership Absolutely. Is not a flexible life, but renting obviously is. I'm a great example. I rent, but here's another point, and this is why renters aren't monolithic anymore. You're capturing a much broader set. We have the inventory now. 10, yep. 20, 30 years ago, you didn't have high-end, amenitized, well-located inventory in cities you want to live, and that's you're capturing a broader renter pool because you have products to sell them that maybe you didn't before. And so I personally value the flexibility, the amenities, the lifestyle, I don't want another job. I work hard enough. I look at home ownership as another job, and that's not the job I want. Okay, I'm going to move on to distress because we're right on schedule, but I just want to make sure that we stay there. So in terms of distress, I guess the two things that I want to talk about is what you're seeing. Let's just start there. Are you seeing any forms of distress across the multifamily segment, and where is it, and what does it look like?
Yeah, no, that's the hot topic, and I'll tell you this kind of quick anecdote. Late last year, I did a survey on my social media platform, just asking people, "Hey, do you think there's going to be more outside of office? Let's exclude that. Are you going to see more distress or groups chasing distress?" And it was like 75% said groups chasing distress, right? And it's obviously very non-scientific poll there, but I think it was illustrative of a point which has continued today, which is that you're just not seeing as much true distress hitting the market as people expected to see at this point. I think there's a lot of, I would say, lowercase d distress. By that, I mean like groups that are having to, deal with, floating rate debt, how to figure out how to, refinance or restructure, extend, or whatever they need to do workouts for the lender. But we're seeing that lenders have been generally very flexible and patient, and we're seeing that buyers or owners for the most part aren't being forced to sell, other than in some pretty isolated cases that tend to make headlines. So I think at some point we're going to see some of this come to the market. It has to be dealt with at some point, but I think it's going to be pretty concentrated, especially in I would say lower tier properties, older Class C that need heavy value add work. And I don't want to get too much in the weeds here, but just at a high level, we saw a lot of cap rate compression between A to B to C in this last cycle. And I think we're going to have to see some of those spreads return a little bit. And I think my guess is that when the dust settles, the distress that's out there is going to be where there's a fairly limited buyer pool. That's going to be these, older properties and lower, less desirable locations that require a lot of work. And I think that's the stuff that's going to be the most, difficult to work through.
Yeah, I completely agree. And usually in market highs, when rates are very low and capital is flowing to an asset class, in this case, multifamily, you see all the spreads Jay's talking about. They come together and consolidate. And if there's one thing, like if people are interested in this space in general, there should be a spread between a Class A and a Class B building, a Class B and a Class C building, a Class A market because of liquidity, and a Class B market, a core market and a tertiary market, a growth market and a stagnant market. There are all these spreads that exist, and they all kind of collapse when there's a mania like there was in 21. And like one lesson that, if you just take one thing away here is don't buy into that, because when things normalize or if things get tough, all those spreads widen quite a bit. And so, if you're going to buy a 4 cap in 2021, make it a really quality asset in a growth city that's institutional in nature. Like don't buy a 4.1 cap because you got a tiny bit better price in a tertiary market. It's Class C, it's 30 years old, whatever. Like and all that stuff happened. And so that it's an unwinding of that. So my point is, in terms of distress, don't get anchored in the great financial crisis of 2008 to 10. This is a very different environment and correction. The economy's strong, first of all. We're not dealing with a deep recession. We're dealing with a lot of multifamily assets that traded at valuations that were too high. That's why Origin hasn't bought an asset in 4.5 years. We're about to buy our first asset, literally, in 4.5 years. Last one was February of 2020. And so we sat this out for a reason. We told you why. Now is actually the time to start sticking your toe in on quality assets. They're not trading a 4 cap. Now they're trading 5.25. But you have to be careful. And the distress that we're talking about, it's going to come in the forms of high quality assets that you can buy during lease up, restructuring the existing capital structure, and buying them 20% below replacement. We're doing that in a Western market right now for one of our funds. I can't speak to it because it's an off-market transaction, but if you're in Income Plus, you'll learn about it. What you won't see is the opportunity to buy high quality assets by buying the debt from a bank at a discount with the equity completely swept. That was the 08 to 10 period. We did it. That's not what's happening right now. It could, but it's going to take another exogenous shock. It would take interest rates going from their 4.2 today in the 10s. They'd need to go to 6. That would cause it. I don't think that's likely because inflation's trending lower. It would take a recession, which doesn't seem apparent right now. That would be an exogenous shock. Unemployment's 4%, right? It's quite low. So absent exogenous shock, you're going to be sitting out this opportunity to buy if you're waiting for that level. Okay, so we are 35 minutes in. We've covered everything except consolidation in the space. You can speak to that really quick if you want, or I can, Jay. But in any corrective period, there's usually consolidations either through M&A or just capital flows. Have you seen that?
Yeah, I mean, we're seeing a little bit of that, right? I mean, we've seen the Blackstone deal with Air Communities taking a publicly traded REIT private. They did the same on the single family rental side. There's a couple more I think are going to be coming here fairly soon. And I think I'm of the belief that we're going to enter into a period where you're going to have some groups that are prepared or kind of equipped and flexible enough to be active buyers, and others that are not able to get through it or could, but just see this as an opportune time to exit. So I think we're going to probably see more consolidations.
All right, we're right on schedule. I'm going to start on questions, and I want to, let me see here. I'm going to just ask the first one because I'm having difficulty with this Q&A feature, but the first one was about cap rates, and I apologize because I can't see the question, so I can't see your name, but the question was, where do you see cap rate? I'm sorry, this is Brandon. Thank you for your question, Brandon. Where does Jay see cap rate projections for Class A multi in the Sun Belt in 24 to 36 months? He's very specific. You're on the record.
Yeah, it's tough. Yeah. Well, obviously, there's a lot of factors that could impact Class A cap rates in the Sun Belt. I don't want to evade the question, but I will say this, is I think what we're seeing is that the cap rates have obviously not risen as much as interest rates have. And I think there's a lot of capital that really wants the same stuff, which is pretty much what you just described. I mean, this is the sweet spot right now for a lot of buyers is Class A Sun Belt, assuming it's a well-located market, whatnot. So, I think this is where you're already still seeing, you mentioned some deals that are trading, 5 and even sub 5 in some cases. So I think those, I don't know that we want to underwrite it, but I think that's where you can make a case that maybe even, going further below that. Now, I will say, on the current trajectory, I don't see a path where that gets meaningfully above low 5s. Even if rates didn't dramatically change, that's everybody's buy box right now.
Yeah, I think cap rates, they're depending on how you underwrite, 4.8 to 5.2 right now. I mean, that's what I'm seeing in our markets. That's usually, and if people are in the industry, that's on tax adjusted year one type revenue cap rates. And in many cases, they're lower if you do them on in place tax adjusted because people still are pricing in some rent growth. But I don't know where cap rates are going is my answer. I thought there was an asymmetric risk towards them going up in 21, 22. Now I think that there's an equal distribution to both sides, and I also believe that it's tighter. And so, like if you think about, let's talk about the risk-free rate for a second, because that's very much related to cap rates, cost to borrow. The 10-year note yield, its first high was 5%. Its second high was 4.75. Its third high was 4.58. Now it's right around 4.22, and it's similar with its low, right? It came off a low of 1.8, went all the way to 5, and then the last time it went down, it only went down to 3.85. Was there briefly. The point is, it's consolidating around value, and if you read what I wrote last I guess my Q4 annual prediction article was about where I thought the risk-free rate would be, and I said, between 3.5 and 4.5. At the time, it was 3.8. And I'll stand by that. Like, I think that inflation is plus or minus 3%. You need a real return of about 1%. So the nominal rate should be around 4. And I actually believe cap rates are going to be similar because there's going to be growth. So that should keep cap rates fairly low. The one thing that obviously isn't true, Jay, today is you're not getting positive leverage from borrowing, because we obviously don't borrow at the risk-free rate. We borrow plus or minus 150 to 250 above the risk-free rate, depending on asset class, cash flows, et cetera, for stabilized. So, you're borrowing above the cap rate, which isn't what you want to do. The belief is growth will take you through. I'm going to move to Richard had a question. He actually has quite a few questions, and thanks for them all. The first one, Jay, is how might persistent inflation impact long-term trends in the housing market, both for renters and home buyers? What are your projections for inflation's impact on housing affordability?
Ooh, that's a good one. I think, first of all, people traditionally think of rental housing as kind of a hedge against inflation, and there's been a few other variables that have challenged that a little bit. But I think that in the long term, obviously the harder it is to be able to buy houses, I think it keeps people in rentals longer. I think, again, where I think some of that's going to benefit the build to rent space more than traditional apartments, as I mentioned earlier. I will say, though, too, I think that the other thing to watch for is, do policymakers start to create more policy solutions to encourage home ownership? And so that's why I'd be leery about going too far down this path, because, can we see more 0% down payment programs, about portable mortgages, things like this. So I think there are some wild cards, even with a higher inflation, higher for longer scenario with inflation. But I certainly, on the surface, assuming it's not very crazy high inflation, I don't think it would have a negative impact on rentals.
Richard, thanks for you asked a series of questions. I'm going to address your third question, which was, how resilient is the apartment construction market to the economic downturn or further shocks? What are the potential risks associated with construction? How are they being mitigated? Do you want to cover that, Jay?
Well, yeah, sure. I think that the construction industry is already, or the apartment developers have already been impacted. It's a very different. A lot of times people, I'm sure this group understands, but the apartment developers are not like home builders. They're not building, with most of their own money. Like, they're having to raise capital, raising equity and debt to build new projects, and it's a very challenging environment to do that for the reasons we talked about earlier. So, it's already a challenge. I think that they're already feeling the shock, and so an economic downturn would not dramatically change that condition. This would prolong any kind of recovery in starts. So in terms of the potential risks associated with this level of construction, so I think the real challenge is, if we hit a recession tomorrow and you're still having peak deliveries for another 6-9 months, there's going to be a added challenge to absorbing that product. But at this point, I think the chances of that occurring have been lessened given the resiliency of the economy.
So, Richard, if you're talking about the actual general contractors, not the developers, the way that you mitigate that risk is you work with the largest, best capitalized general contracting groups. You don't want in these markets to be with less capitalized general contractors. So that's how I would answer that. The other thing is it's construction inflation, meaning the cost to build, has really flattened across the whole country. Those costs aren't going up, and they were going up quite a bit in 21 and 22. In 23, they flattened, and it's actually in a lot of markets now it's negative. Florida is a great example. We're seeing significant cost savings on projects that we're looking at now that have materialized in the last 4 to 6 months, because there's this huge slowdown in starts, and general contractors and subcontractors for that matter, they need to stay busy. And so they're willing to work for much lower margin. And so it's not all bad, is my point, but you do have to mitigate your risk by working with the larger, better capitalized general contractors and subs, by the way, too. And so it's not easy enough as a developer to say, oh, I'm with a great general contractor, I'm all set. You actually have to understand, based on the region and what you're doing, who the right subs are to work with too, and get in the weeds. Next question, Nicholas asked, what are the main quantitative aspects you look at when entering a new market or city? What would you do there, Jay?
Well, yeah, that's a good question. I think, you mentioned earlier the importance of just, not being in the flash in the pan market. And so I think what you want to look for are markets that have long-term staying power. And so I do think there's some markets that are emerging out of COVID that, definitely have a higher risk profile than, let's say, a Dallas or a Charlotte, et cetera. But, certainly you can make a bet on as kind of smaller markets with some long-term tailwinds. And so I think what you want to look for is, are these places that have just been growing since COVID, or are these places that were actually below the radar prior to COVID and have some real things going for them in terms of population growth? And of that population growth, is it the right demographics, meaning, primarily for multifamily, that's 20s and 30 somethings come into that market. The economy there, is it a mix of jobs, or is it primarily driven by, one sector? I think that's an important consideration as well. And I do think there's some examples of some of those things that are happening. So those are a couple examples, some things I'd look at as sustained population growth, lower cost of business, lower cost of living, and at least a fairly diversified job base.
So we mentioned earlier the idea of units per capita. That's very important. Units is obviously supply and coming supply. Jay mentioned that that's measurable, which is good. And then per capita means household formation, which your drivers are population growth and job growth. You want these cities to be places where people are choosing to work and live. Our machine learning, we get to leverage, right? It takes in billions of pieces of data a month, and it's making these unbiased predictions about not just the cities, but the submarkets you want to be. But there's also some common sense. We live in our markets. Our people are there every day, living, working. And I'll give you an example. We cover Phoenix, and we as a company have been looking at Tucson for years. Why? Well, the affordability ratio is quite good. It's a large city that if Phoenix is going to price out renters in the same way that Colorado Springs benefited from Denver doing that, maybe that could be Tucson. And then the other thing to look at are anchors. So if Tucson is something you're interested in, and I was, then you start to look at, well, what's an anchor? Well, one anchor would be University of Arizona, and another anchor would be they have a large airport that's available. So the ease of use of a city is also important, by highway, by air, et cetera. And so all of these things matter when you're looking at real estate. If you don't have machine learning and data, you can get a long way with just old-fashioned research and putting together pieces both at the city level and the submarket level. Jim asked a question. Thanks for your question. Is 20% down a universal requirement for home purchase? Absolutely not. I believe you can buy a home for 5%, certainly 10% down. It's just 20% is something that I think it's difficult for people to put that much money down. And if you're not, so let's go through the scenario where you put 5% down. That doesn't require a lot of capital, so that's good. But then you have to pay the PMI, so you're paying mortgage insurance on top of your mortgage. But you're also financing 95%. You only put 5 down, and the 95% is being financed at somewhere between 6.5%, 7.5%. That's the cost of a mortgage. So, and now if you're amortizing, your loan constant's quite high, and then you add the PMI to that. So the less you put down, the more it's going to cost relative to renting in a home, renting a home versus home ownership. But no, you don't need 20% down. Jay, did you want to add anything to that? I think we froze Jay, so I'm going to keep going. Jay, if you come back online, you let me know. Oh, you're back.
No, you covered it.
I see you moving again. All right. You did not want to add to that. Okay. Any more questions? Please send them in now, because I don't see more at this point. Okay, I see them. A bunch just came in, Jay. You're not off the hook yet. So Robert asked a question: is there any way to predict QOZ1? Robert, Jay can't answer that, but please, that's a fund that we're in. Email me at david@ord, and we'll handle your question offline. Richard asked another question: are there any market segments or property types that are more vulnerable to the stress? I think you covered that. But go ahead, you can cover it again.
Yeah, can you hear me okay now?
Yeah. Mm-hmm.
Okay. Yeah, no, I think the challenges are going to be concentrated in older Class C properties that require a lot of value add work. I mean, a lot of CapEx, and in lesser desired locations. I think that's where the challenges will be concentrated.
I'm not going to add to that. That's spot on. So Arun asked a question about highly leveraged multifamily properties bought at 21 highs, value add, what's their future, et cetera. Here's the interesting thing. I could say a couple different statements and they're all true. Multifamily real estate it's corrected 10 to 15%. That's a true statement. Value add real estate that was purchased at the high has corrected 40% from that price. That's true too. And so I would have to see the deal, Arun, but there's certain deals that traded in a market like Phoenix, for example, that never would have worked. It was completely irrational. They were trading at 3.2 caps, and then they put on variable debt. And there's a whole group of deals where the equity's gone. There's no equity left. They funded them 70-30, and they're down 30-40% at the asset level. So it depends is the answer. When I look at deals like that, and we do, I've seen stuff down 30-40%, and I'm not ready to buy it yet. It's still not, when we run our numbers and it's the asset quality, et cetera, it's not something I would want to buy now. But because now it's trading a 5 cap, I don't want to buy it at a 5 cap. But that's a heck of a lot cheaper than when it traded at a 3.2 cap. So this is the challenge with multifamily. We have this amazing asset class that has really strong fundamentals, but a lot of investors maybe got into the wrong deals at the wrong time. Jay, do you have anything to add?
Yeah, no, I think you nailed it in the head. So I mean, just real succinctly, I think it matters less about what someone paid for it previously and more where you see value. And again, I think that a lot of times it will depend on what it is, and there's going to be a larger that 30-40%, and again, that Class C deal that still requires a lot of CapEx work is very different from a property that's requires no CapEx and is down 30% and is in a great submarket. So I think it still comes down to the individual deal.
So Reed asked a question about baby boomers and the active adult industry. We are doing some active adult, Reed, so I'm familiar with it, obviously. Jay, can you speak to that a little bit? It's a newish segment. I wouldn't say it's that new, but it's certainly in the last 10 years.
Yeah. Well, I think it's a very interesting segment, and I think in general, we've seen some really mixed things with senior housing, but this active adult one is particularly attractive because it has the complexities of the care facilities, and typically you're able to get a little bit more of a rent premium than you would for a traditional market rate conventional apartment. And so, the way I like to think about it is everybody's asking about, hey, all these boomers can retire and downsize. Well, even if I think the good news is for this space is that even if the percentage of aging adults that chooses to rent doesn't move, the sheer numbers of baby boomers compared to the prior generation, just the number of people who are moving into that phase at a stagnant percentage that are choosing to move it still amounts to a sizable shift in demand. And so I think active adults in the right spots, particularly for, we hear anecdotally about, active grandparents who want to maintain a place at least part of the year to be near grandkids, and have, a place where they can have an anchor, or those who are just relocating, want to have some more flexibility in that stage of life, maybe plan to travel a lot. I think there's a real strong niche there, in the right locations. And while there's been some construction in this space, it's definitely not been, for the most part, hasn't been over the top in most locations. So I do think that's a location of a specific segment that does have some wind at its back.
Zach asked a question that I'll answer. Does your machine learning, that's multilytics, consider climate risk, especially in the Sun Belt? Zach, we've actually looked at that extensively. It doesn't itself in the machine itself, but we studied it through our own data because we wanted to address this head on. And what we found, and again, email me at David@Origin Investments if you want to talk offline, but our data science group, what they found was, and this also applies to water rights and water unavailability or difficulty getting it in the West, for example. What we found is it's not a very determinate variable. And so, again, we sort of address this with the idea of the media, what it covers and what matters. We did it under the veil of the renter. They're not monolithic. This idea of climate change and what it does is not significant going forward. Now, an exogenous shock here would be if the pace of disruption of weather were to pick up dramatically, then that would be exogenous. So if you think that, we're going to go from 1 to 2 hurricanes per season to 15 that are all material, that would matter, right? But if it's going to be sort of like it was, we don't see it as that big of a determinant. There's others that are much more important. So that's something you would have to think about. Okay. The next question, we only have really time for one more. So I apologize if we don't get to them. We do have a few more. David@origininvestments.com. I will answer that, or I will put you in touch with one of our team that will do so. The last question you can handle, Jay. Anthony asked the question. The narrative is that the U.S. is underhoused. What percent is allocated to market rate housing? I assume that means affordable versus rental. It's a great question.
Yeah. So, that's a complicated question. I could take more than a minute to answer, but at a high level, I'll tell you is there's about 50 million renter households in the U.S. There's something around, the exact numbers are hard to pin down because the affordable housing space is very fractured. But I want to, don't hold me to this, but I want to say it's 6 to 7 million units that are true affordable, in terms of, low income housing. And so it's a fairly limited pie of that. And then we look at underhoused, there is definitely the biggest need at the low end of the spectrum. That said, I will also point out, though, that most of the renter household formation over the last decade has been middle and upper income prices for those who can afford the new supply. So I think there's a need for both, but I think there's some very acute challenges at the low end of the market that require a separate conversation from what we're having today. Because it's people, David, you mentioned kind of monolithic market gets painted as. It is not. The renter market is, anytime you see headlines painting renters in one broad brush, it's not right. And there's a lot of renters who are financially in strong shape, have been resilient, and that's a good story. At the other end of the spectrum, there are a lot that are struggling to get by, and we need more housing for those folks as well.
Last question I'll answer is from Jessica. What types of returns we look for in multifamily deals right now? That obviously depends on the strategy. Origin has credit strategies that sort of target 10 to 12. Development would be more like 16 to 20, but you're taking more risk in development versus credit. But to answer the question broadly, and we've talked about this internally and externally, I think that this is the time to actually start taking risk again. And we've been very conservative for 4.5 years. I'm not feeling like it's a time to be conservative right now. So investors often ask me, where should I be investing? And I've been urging people to go into credit, real estate credit for years. And now I'm more, of the side of, credit's still interesting, but you might want to actually stick your toe in equity, because in credit, you don't get any of those upside distributions, right? You're going to get 10 to 12. And if the deal does really well, you're still going to get 10 to 12. That's credit. Equity gets that upside tail if it works. So that's my opinion. And it's based on my belief that the fundamentals are really improving, mainly caused by a really, really violent correction in the amount of new supply in the form of starts, which we covered for the last 6-7 quarters. And it's still happening. So like as we said today, it's still very difficult to get a real estate development off and running. And because Origin is one of the larger developers in the country, we see it, right? I'm in the middle of that. I have a front row seat. It's very difficult to get developments off the ground. By the way, just in business in general, one of the things you want to do is enter businesses with barriers to entry, because if you can get in, that barrier exists. That's the case in new development today. If you can get it to work and capitalized, it's probably got a great chance of working in 2-3 years. So with that, I'm gonna sign us off. Jay, thank you so much for joining again. And I'm gonna urge everyone that's listening, follow Jay on LinkedIn. He told me earlier he's on Twitter, but X. I'm not cool enough to be on X, but if you are, he's also on X. I certainly read all your stuff on LinkedIn, and I think it's excellent. It's data driven, it's unbiased, it's unemotional, and oftentimes it's a bit counter trend. So I appreciate it. Jay, thanks for your time today.
Thanks for having me.
All right, have a good day, everyone. Bye bye.